Okay, let's talk about the next 20 years. If you believe that electric vehicles, semiconductors, and renewable energy are going to keep growing, and that's a pretty safe bet, you have to ask yourself a critical question. Who's going to supply all the mission-critical materials that make those things work? Well, today, we're going deep on Gujarat Fluorochemicals, or GFL, a company that might just be the secret sauce behind this whole tech boom.
Right. This is the big question. And the answer isn't about the flashy brand names you see every day. Nope. It's hidden away with a company that a lot of investors just don't quite get, operating in the super complex world of advanced materials science.
So let's start with the situation. We are in the middle of a massive global shift. Think about it. Electrification, everything going digital, the push for clean energy, all of this is creating this huge structural multi-decade demand for some very specific high-performance materials. And right at the heart of this are these amazing materials called fluoropolymers. Now, we're not talking about simple bulk chemicals you can buy anywhere. GFL is all about these advanced materials that are engineered for the toughest jobs imaginable. Places where failure is just not an option.
And this slide just perfectly illustrates how important they are. I mean, we're talking about the binders that hold EV batteries together, the materials used to make microchips, even components in airplanes. And here's the kicker. Once the company designs one of these polymers into their product, the cost and hassle of switching to another supplier is huge. It creates what we call an engineering moat.
Okay, so let's get to the complication, because this is the brutal, honest truth about this industry. The chemical sector is absolutely notorious for destroying capital. Seriously, it's a graveyard for investors who get the timing wrong.
And here is the absolute #1 risk. A company spends billions building shiny new factories right when everyone is optimistic. But then, just as those factories are ready to go, the market turns, demand dries up, and profitability gets completely obliterated. If you get this timing wrong, it's like hitting a kill switch for your investment. And trust me, we are going to break down every single one of those kill switches a little later. So, this brings us to the core dilemma, the big question mark hanging over GFL. Is it just another commodity chemical player, totally at the mercy of wild market swings? Or is it a true specialty materials company, one that has real pricing power because its products are so deeply baked into its customers' most important processes?
And this leads us to the action GFL has taken. Faced with this exact problem, the company has made a very deliberate, very high-stakes pivot in its business model. You could call it a strategic shift from selling bulk stuff to selling brains.
And you can see it happening right here. They are purposefully shrinking their exposure to the lower margin, more commodity-like refrigerant gases, and instead, they're aggressively growing their business in high-margin specialty fluoropolymers and battery chemicals. The key point is that this is a margin accretive shift. It's designed to make the whole business stronger and more profitable over time.
This quote really gets to the heart of their competitive advantage, their moat. It all comes down to one thing: trust. I mean, think about it from the customer's point of view. You can't build a reliable, high-performance EV battery or a billion-dollar semiconductor fab using chemistry that you can't trust. So once GFL's material gets tested, validated, and approved for a sensitive production line, that customer is basically locked in. The risk of trying to requalify a new, unknown supplier is just way too high. All right, so a great story is one thing, but you and I know the numbers have to back it up. So let's inject a little financial truth serum here and see if the data actually supports this whole specialty materials narrative.
So, looking at the vital signs, we see some really healthy indicators. First, a strong return on capital employed, or ROCE, consistently above 20%. That means they are generating fantastic profits from their investments. Second, you've got high promoter holding, around 62%, which means the people running the show have serious skin in the game. And finally, they've been disciplined with their debt. These are not the signs of a struggling commodity company.
And if we zoom out and look at the 3-year trends, you see the story building. There's a clear pattern here: strong growth in both sales and profit, and, this is the important part, their profit margins are getting better as that specialty business becomes a bigger piece of the pie. This really backs up the idea that what we're seeing is more than just some temporary cyclical upswing.
So, here's the crucial question. Are the earnings they're reporting real? And the answer here is a big, resounding yes. You can see that their cash flow from operations has consistently tracked the reported earnings. In plain English, that means the profits aren't just some accounting trick. They're backed by actual cash flowing into the company's bank account. That is a huge green flag for earnings quality. But, and this is a big but, this is not a risk-free story. Not even close. Now we have to talk about those kill switches I mentioned earlier.
These are the absolute worst-case scenarios that could permanently destroy capital and just torpedo this entire investment thesis.
All right, the two biggest threats are the classic chemical industry killers. First, global overcapacity. If China or other big global players like Chemours or Daikin decide to just flood the market with cheap supply, it's going to crush pricing for everybody. Game over. Second is internal indiscipline. What if GFL's management gets a little too excited by all the EV hype and overbuilds capacity way too fast? Well, then the return on capital would just completely collapse.
And the list doesn't stop there. We also have to keep an eye out for a big technological shift in battery chemistry that could make fluoropolymers obsolete, or a sudden environmental regulation that shuts down production, or a state-backed price war from China, or even just a drop in GFL's own R&D spending, which would slowly kill its specialty edge. Lots to watch.
So after weighing this massive opportunity against some very, very serious risks, we finally arrive at the last part of our resolution. What's the final verdict on Gujarat Fluorochemicals? The thesis is actually pretty straightforward when you lay it out like this. GFL wins if it keeps executing this disciplined shift into specialty materials, if EV demand keeps growing like we think it will, and critically, if its new investments keep earning those high returns. It loses if those big external forces like global overcapacity or internal mistakes like overconfidence get the better of them. And this right here is probably the single most important takeaway from this whole explainer. GFL is not a safe, sleep well at night, defensive stock you can just buy and forget about. It's a specialty materials company with some powerful long-term trends at its back, but it also has real cyclicality and very real execution risk. It's what you'd call a controlled risk allocation.
So what does all this mean for you? Well, it means this is a company that absolutely demands active monitoring. An investor has to watch that Capex cycle like a hawk, keep a close eye on what's happening with global supply, and just understand that while the potential upside here is significant, the journey is almost definitely going to be a lot bumpier than a core defensive holding. It's a bet on a huge structural trend, but it's one that requires you to do your homework and stay vigilant.